This morning, oil is now below $70 a barrel after jumping up $3.90 yesterday. Oil settled above $70 a barrel on Wednesday. The EIA's weekly inventory report showed an unexpected drop in barrels, 1.6 million in fact, last week from the previous week. And according to a Platts survey, analysts expected a jump of 1.2 million barrels, so a big difference there. Natural gas inventory reports are due out later this morning. Right now, the latest numbers have oil down 80 cents at $69.81, natural gas down 16 cents, selling at $4.74. Joining us now for a closer look at the inventory reports, both past and present, is our regular analyst, Elliott Gue from the Energy Strategist. Elliott, good Thursday morning.
Morning.
Good to have you with us. Let's start today on oil, if we could. A major discrepancy, as I pointed out, between what was expected yesterday, a build, and what actually occurred in terms of oil inventory.
Yeah, and that actually breaks the last 2 weeks we've had more bearish than expected reports, where there's been a larger build in crude oil and gasoline inventories than expected, and much larger build than expected. So this week, we saw an unexpected drop, and that really changed sentiment in the market pretty quickly.
What's the reason here in the U.S.? Is it gasoline demand? Is it the economy actually picking up steam once again?
I think it's a little bit of all those things. We did see in their numbers, as part of that EIA report they compare the last 4 weeks to the same 4 weeks period a year ago. Gasoline and overall oil demand is up year over year now.
Let's talk about the international picture briefly then, Elliott, because OPEC has apparently had another production cut, or at least production is down for the second time being announced by the cartel. On the other hand, we have China dropping in demand, which is a significant development over the last week or two. What's the biggest factor at work right now internationally?
I think people are looking at OPEC and how much spare, a little bit longer term, they're looking at how much spare capacity they're likely to have. Obviously, when demand fell off a cliff a year ago, we went from very tight spare capacity situation to quite a lot of extra capacity available anytime to be brought back online. Most projections over the next few years show that spare capacity gradually dropping as demand starts to come back into the market. And if you look at the history of oil, at least since OPEC started having a major effect, it is highly correlated to spare capacity. In other words, if the more spare capacity there is, the lower oil or the weaker oil prices tend to be. And so we saw spare capacity jump last year. That's why oil prices came back down. This year and next year, they're expected to gradually decline. As that happens, you can expect oil prices to go back up. China, that would be a concern if that continues. We definitely, a lot of the move we've seen in oil off the lows last year has been predicated on the idea that the emerging markets are going to be a major source of demand going forward.
What about the Middle East, if we could turn to that for a moment, Elliott? Last summer, you merely said the words Straits of Hormuz, and oil jumped $5 a barrel, it seemed. Yet here we are with potential sanctions on Iran and all the potential fallout from that. It doesn't seem to be affecting the markets too much right now.
Again, I think a lot of that has to do with the fact the oil market isn't as tight as it was a year ago. Last year, I think at one point we had about 2% spare capacity in the world, meaning that was out of all the oil demand, only about 2% could be brought up very quickly to handle supply or demand shocks. So then you have the Straits of Hormuz shut down, you have some sort of, say, a military action in the Middle East, immediately that spare capacity goes away and you have a problem. This year we have very high inventories of oil, dropping, but still very high inventories of oil in the United States and some of the other developed countries. And you have quite a bit of spare capacity around the world, mainly in OPEC nations, granted, but certainly the situation isn't quite as tight as it was a year ago. Therefore, you're not going to see quite the same effect.
In just about an hour and a half, the EIA's report on natural gas comes out for the past week. Another build in storage seems likely, but you were saying you think the build will be once again lower than expected.
Well, that seems to be the trend we've been seeing over the last several weeks. The consensus is about 62 billion cubic feet for this week. We've been hanging out in that 60 billion cubic foot build area the last several weeks, but it's always been the last 5 weeks in a row, it's been a little bit less than expected on the build side. We did get the EIA's monthly natural gas report, which came out on Tuesday, showing that U.S. natural gas production is falling pretty rapidly. We saw the first year-over-year decline in U.S. natural gas production. Now that report only shows through July, so the rig counts remained pretty weak since, so you'd expect that to continue. But a big drop-off in supply from Texas, big drop-off in supply from Wyoming. Really the only state that showed real growth was Louisiana. But that's a pretty small producer still in total percentage terms. So it does appear that that story we've been talking about for months now, declining production and possibly an uptick in demand as a result of the economic recovery, is starting to tighten up the natural gas market a little bit.
In your mind, Elliott, does that mean that the industry is slamming on the brakes in time to avoid peak capacity and storage?
You know, I still think there's a pretty good chance we're going to get there, or if we don't get there, certainly you're going to see a lot of shut-ins. One of the reasons that you know, you see a big drop-off in some of those Rocky Mountain states over the summer was shut-ins. So you might see that it really pick up over the next few weeks. But you know, the closer we get to the end of the injection season, the less of a problem that becomes. So by early November, we should start to see gas inventories going the other way. And I do think that the natural gas market is now looking beyond the next three weeks. They're starting to look at, you know, what's the supply-demand position likely to be, say, January, February, March of next year. And I think provided we don't get a very unusually warm winter, and you know, people say El Nino has tended to cause warm winters in the past. It's actually a pretty mixed bag. If you look at a moderate El Nino, parts of the country tend to see a little bit warmer than normal weather, but the Northeast, for example, doesn't necessarily. So unless we get a much warmer than normal winter, I think you're going to see natural gas inventories really start to drop aggressively relative to the average next spring, and that should put a pretty good bid under natural gas prices.
Elliott, final question for you, and I guess I'm asking for a hypothesis here in terms of what would happen price-wise if there is some consensus that we've reached peak storage.
You know, again, I mean, I think that the near-month futures, the spot prices, they could be affected severely, because if there's nowhere to put that natural gas and it sort of just is dumped on the spot market, you could see those prices come down. But looking the futures out past, say, November, December, January, I don't think you're going to see as much of an effect on that. And that's pretty much what we've seen since the end of summer. You've seen those near-month futures and spot prices come down aggressively. There's been very little effect, or certainly a much more moderated effect, going out into next year. And I think that reflects the fact that, and if you look at the strip price, say the average of the next 12 months, it's basically been trading in a range since February. The natural gas stocks, the drillers, the services companies, have been really moving higher. And I think that reflects that, you know, though there's some concern near term about storage levels, as we, you know, the longer term view is much more bullish, and that's what really a lot of these stocks and the farther out month futures are being traded on.
All right, Elliott Gue is editor of the Energy Letter and the Energy Strategist, a regular analyst here on Clean Skies News. And Elliott, the latest EIA coming out in about an hour and a half. We'll see what the numbers hold.
Sounds good.
Thanks for joining us.
Thank you.